stepped in to shoulder the trouble is Prashant Kumar, the Managing Director and CEO of Yes Bank, formerly CFO at SBI. Mr. Kumar, good morning and thank you very much for taking our call. Sir, the questions are troubling. I have great admiration for what you are shouldering in Yes Bank and how quickly you produced the Q3 numbers. But the questions are troubling from the point of view of both investors and the financial sector. So first question to you, sir. This concern as whether Yes Bank can continue as a going concern rises because the CET1 has breached. It's at 6.3. The regulatory requirement is higher. As well, deposits, the way in which it's depleted, that has led to the LCR. I believe the liquidity capital ratio is also way below the 100% that it has to be. It's at 34%. So how do you expect to bridge these two initially?
So good morning. And I think what we need to see from the Yes Bank perspective, not about YOY. I think what we need to see from the date when the moratorium was imposed on the bank.
Yes.
So I think, yes, bank was in trouble. That was something which was accepted by everybody. And after that, reconstruction of bank was done. So I think we need to see from that angle.
Yes.
And if you see on the, say, the strategy part, I think on both the NPAs as well as the NPIs, we have taken the provision coverage ratio up to 74%. So basically now the strategy is that if after taking this provision coverage up to 74%, if we decide either to segregate the entire NPA part within a separate vertical within the bank, or maybe if it is, say, parked in ARC or a bad bank, which we are talking about. So whether bad bank is created outside Yes Bank or whether it is created within Yes Bank, the remaining bank would be very healthy. If you see on our retail side, the asset quality, and after 74% provision, there is absolutely no need to have any additional pain on account of this.
Okay, but
another part, if you have seen, we have insulated our balance sheet from any impact of the past. So now, basically, what we need to see, what is going to happen in future, and how it is going to impact the balance sheet. So balance sheet has been insulated. That is one part. Second thing, if you see on the liability side, I think immediately after moratorium, everybody was expecting there would be a huge outflow. There was an outflow, but I think from 1st April onwards, that has been stabilized. And I'm very, very happy to share with you that during the month of April, the number of retail term deposit which we have raised is more than any of the months during the financial year 2020.
What was more, sir? What was more? Sorry?
It's a number of retail term deposit which we have originated during the month of April is far more than any month during the financial year.
How much more retail deposits could you get?
So basically what is happening, if you see, this bank was dependent on the wholesale deposit.
Yes.
Now this wholesale deposit, we are moving from the granular deposit. We have stabilized after 31st March. We have a very, very strong customer connect at the ground level. I think during the month of April, despite the lockdown, our teams at the ground, they have connected to the customers, I think the highest level, including myself. So the entire bank is reaching out to the customers. And I think we also need to appreciate one additional thing. We are the market leader on the payment side. So after the moratorium, some of the very large our customers who have moved away from us because of the moratorium, we have been able to get back them. So very large payment space, some of the large cash management products, they have come back to us. So technology side, we are very, very strong. So this technology we are using in two ways. One, getting back the liability side. Another, now we are using the analytics on the basis of the huge payment data which banks have to connect to the customers and getting them back. So I think going forward, this would not be very difficult. Yes, the COVID situation has complicated. But the way we are getting the response from the customers in terms of the type of service which they are getting,
Yes.
and the way the customers are very, very positively responding to our technology capabilities, I think very soon we would be able to meet our liability deficit.
No, I take your point on the deposits. Although your deposits had declined from March 5th to March 31st considerably because of the moratorium, if I look at the March 31 number and the latest number, May 2nd number, deposits have remained stable. So clearly that piece has worked. But you still need money, isn't it? Your CET has been breached. Your LCR is way lower than what it should be. And you have told us very clearly that the moratorium has been accepted by 45% of the people. And that could mean that some part of it will actually default. At least the BBB and below, which has increased to 11%, that can default. So where will that new money come from for bringing up the capital, for the LCR, and for the fresh NPAs that may come from the moratorium lot?
So there are two things on this. I think we have done our calculation. Our CET is at 6.3, and if we need to meet the regulatory requirement of 8%, we need another 4,000 crores of capital. But as a strategy, we would like to take this CET1 to 10% to absorb any future shocks. And for that, we require additional 4,800. So basically, I am talking of 8,800 capital to reach at a CET ratio of 10%. And we also need something more for the growth. We already have the approval to raise capital up to 15,000 crores. And another very, very important point which we need to see, that once we reach at a 10%, not only we would be able to absorb any shocks in future, but also because we are having the DTA, whereby 250 basis point of the capital is locked in. So the moment I am able to do the recoveries and I am able to raise capital, this 250% capital would also be released from the DTA over a period of 12 to 18 months. So balance sheet is absolutely insulated now. And yes, we would be reaching out to our investors with a very, very clear-cut strategy, how we are working on the technology, and how after segregating the bad loans from the remaining bank, how the remaining bank would look like. And I can tell you that in next 18 to 24 months, the remaining bank would be a class, and it would be in the first 3 private sector banks, if you see the various ratios. We can come out with that part in a couple of days.
Okay. Mr. Kumar, good morning.